Dow and Nasdaq futures and the Indian equity indexes are all up nearly 2/3% after very sharp cuts in the past two trading days. The relief rally has come after US Commerce Secretary Howard Lutnick said that the 25% tariffs on Mexico and Canada that became effective on Tuesday could be reconsidered, and the US may meet the two countries in the middle. That's his quote. Well, given what we know about tariffs, will this middle ground help, or will it continue to harm the US economy, this increase in tariffs? Is the US exceptionalism ending anytime soon? For all these questions, I am joined by Jahangir Aziz, Chief Economist, Emerging Markets at JPMorgan. Jahangir, good evening, and thank you very much indeed for staying up for us. The immediate statement, Lutnick says that Trump will meet Canada and Mexico in the middle. Now, can markets live with that and recover sustainably?
Obviously, after the shock of 25% being extended on both Canada and Mexico, if you scale that back, there will be a relief rally. I don't think there is any doubt there won't be a relief rally. But let us not forget that this has been played before, and within a 1 day's time, the tariffs were delayed. We got the tariffs back within, let's say, 48 hours. They get diluted. I think what it does to the market is to raise the level of uncertainty around trade, and this is not the only thing that is in the cards. Now, clearly, this is extremely important because unlike 2018-19, and I would have to admit that unlike what I thought was going to be the way in which the tariffs would be imposed, this is changing the geographical focus of the tariffs. It is not, something's happening in China, which, the world has been used to, or to Malaysia and Vietnam transshipment, but rather in the backyard of US, and it is akin to tearing up a 30-year trade deal. So the ramifications of imposing 25% tariff on Canada and Mexico is significantly different than, let's say, ratcheting up the 20% tariff to 40% tariff. We, of course, believe that on China, it'll eventually go to 60%, which was our original baseline, and we still think that that is pretty much par for the course. But this is happening in a world in which the US, Canada, and Mexico have been inextricably tied together through very deep 30-year-old supply chains. And that is where the anxiety of the market comes from. If this was, again, let's say, instead of, 25% on Canada and Mexico, the US goes and raised tariffs from 40% to, say, let's say 60%, which is, as I said, is a baseline. I think the reaction in the market will be far less. Okay. Then the reaction which is happening in between three of the most intricately related through supply chains. I think that's what the concern is. But I think even though you get dilution, I think what this does is to spike up the level of anxiety and the level of uncertainty around trade. This is clearly where the danger lies.
Okay, I get that, these are inextricably intertwined. So, my point is investment decisions take time to decline. Growth takes time to react. But won't inflation come in immediately? Because tariffs means products become expensive right now. So, do you see any rate cuts at all?
So go back to 2018. I'll answer your question, but let's go back to 2018. This idea that investment will take a long time to react was not true in 2018-19. If you look at 2018-19, in July, that was when the China tariffs were imposed. From July onwards, global sentiment completely collapsed in first one leg, and the second leg of the collapse was when the NAFTA was being renegotiated in the USMCA. So I think that the capital investment and capital spending can react very, very quickly. And I would argue maybe it might take a little longer for inflation to react because people have built up inventories, etc. Now, in terms of your question, does it raise inflation? Yes, it does. I mean, if you're going to impose 25% tariffs on, or let's say, the auto sector, right? Where the auto sector of Canada, Mexico, and the US are completely linked to one another. In fact, to manufacture an auto, probably the parts of the auto have to go back and forth between the three countries several times. And imagine 25% tariff being imposed in every leg of that transaction. So just in auto industry, it goes up. Canada has threatened 25% export taxes to electricity to New York State. So clearly, there is going to be a significant inflation impact. The question that you're asking is whether or not the Fed reacts to it. And my sense is that given that this is going to be a supply side and it is going to be a one-off price level shift, the Fed will probably take it in its stride. As long as, and this is the as long as part of it, and is that inflation expectations do not get unanchored. Now, this is where the concern is. So if you look at the two by two break-evens, 2 by 2 break-evens over the last 3 months have already started to rise. If you look at the Michigan survey of inflation expectations of the households, that has started to spike up. So it isn't any longer the case that inflation expectations are sort of anchored. Inflation expected, I'm not saying they're unanchored, but inflation expectations are going up. And if these tariffs go and unanchor the inflation expectations, then I think the Fed reacts. If, as long as inflation expectations remain bound and anchored, I think the Fed will probably not react as aggressively or as early. But the Fed cannot afford not to react to a spike in inflation expectations.
Fair enough. Now, let me come to the markets. Do you think US exceptionalism has ended?
It is getting tarnished. Definitely. I mean, and it's getting tarnished because the idea that whatever happens to immigration policy, whatever happens to tariffs, deregulation, tax cuts, whatever happens, it is going to be growth supportive at the end of the day. And I think what we have seen from this administration in the first 43 days is mostly sticks and very few carrots. And because it has been mostly sticks, we're only seeing the negative impact being hit. And we haven't really seen any kind of deregulation beyond the ones on energy, which again is non-material. We haven't seen anything on the financial markets. There's a lot of hope for it, right? And I think that is where the concern is. The concern is that when do these deregulations come? When do these tax cuts come, right? And what is the size of these tax cuts? What do they do to the fiscal deficit? And if they're going to come later on, and the bad things of tariffs and immigration is going to come first, I think the market is going to react to what it sees first. And that is the reason I think US exceptionalism at this point in time is getting tarnished. I don't think structurally you take a bet that US exceptionalism is over. But I think tactically, this is clearly in asset prices. It is clearly in equity markets or in fixed income.
But that's an important point to make. Exceptionalism is getting tarnished, not gone. So should we continue to expect outflows from India, to the US?
That's what happens in a risk-off environment, right? In a risk-on environment, emerging markets did not get much flows, right? I mean, let's look at the portfolio flows that came to India as an example. I mean, that was on the back of India entering the GBIEM index. And even that managed to get you about $35 billion. You've seen capital flows portfolio flows going back into China, since about October, November, when the policy pivot started. But again, those were on valuations. Those were not based on, that the Chinese growth is going to keep on growing at 6, 7, 8%. None of that was true. So I think that it is very hard to see emerging market flows going into emerging markets when you have a risk-off environment. And as you've known, pretty well that the U.S. equity markets has to do well for the rest of the world's equity market to do well. It is never the case that U.S. languishes and the rest of the world does better. But I would say that to whatever extent you can make that comparison, if you look at European equity markets, if you look at Chinese equity markets, again, maybe it is a reflection that there was too much priced into U.S. exceptionalism. And it didn't turn out that way. And essentially what we're seeing is a market adjusting to more realistic view of U.S. exceptionalism, which is why you're seeing the equity markets in Europe and China actually outperform that S&P 500 or Dow. But it's very hard to see in a genuine risk-off environment flows being attracted to emerging markets.
Okay, so can we say the dollar's excessive rally is over?
Again, the same part of the U.S. exceptionalism story, right? I mean, U.S. exceptionalism story had this part of it, right? The 10-year would go up, yield curves would steepen, and you would get the U.S. dollar to strengthen, U.S. equities to outperform everybody else. I think this is just part of U.S. exceptionalism just getting tarnished. Now, whether or not this is over or not, well, that's a hard call to make, but clearly the forces that would drive U.S. dollar outperformance, that obviously is being pushed back. Now, there is only one thing that is still left behind, which is that the interest rate differential, especially if ECB and others keep cutting rates, that will widen. But I think in the face of the growth differential narrowing, or fears about the growth differential narrowing more than that, I think you are probably going to see dollar weaken from here till this period is over, rather than a dollar strengthening based on U.S. exceptionalism.
Okay, so for now, you're expecting it to lessen because U.S. exceptionalism is getting corrected. Thank you very much, Jahangir Aziz, for staying up for us. I think that's important. What Jahangir says, U.S. exceptionalism is not over. If the tax cuts come, and if they come sooner rather than later, then the exceptionalism will continue. But for now, it's just valuation correction between U.S. on the one hand, or U.S. exceptionalism on the one hand, and Europe and China having gotten way too cheap. A seminal change in the flow of funds is not on the cards just yet. Well, on this Khatta Meeta note, 50% positive for our markets, but not all the way. We'll wrap up on Bazaar. At the moment, at least, we are seeing a lot of green. We'll take it with both hands, and Chartbusters will take the action for.